You check your phone in the morning, you open your brokerage app, and everything is bleeding red. A 30% drop across the board. The news is screaming that the economy is collapsing. Your friends are texting you that they are pulling their money out, and your stomach is in absolute knots. In that exact moment, your brain is going to scream at you to sell everything and run for the hills. And if you listen to that voice, you are going to make the single biggest financial mistake of your life. The truth that Wall Street doesn't want you to fully grasp is that wealth isn't actually made during the good times when everything is going up. Real, generational wealth is forged in the middle of terrifying market crashes. But the harsh reality is that most people are going to get completely wiped out in the next downturn. They will panic, they will sell at the absolute bottom, and they will permanently destroy their financial future. But that is not going to be you. Today, we are going to completely rewire how you look at a market crash. We are going to flip the script so that when the next big drop happens, you are not sweating in fear, you are actually excited because you will be holding the ultimate playbook to multiply your net worth while everyone else is panicking. To understand why people fail so miserably during a crash, we have to look at biology. We have to talk about why your brain is actively working against your bank account. There is a deeply ingrained psychological concept called loss aversion. Researchers like Daniel Kahneman proved decades ago that the psychological pain you feel from losing money is roughly twice as intense as the joy you feel from making that exact same amount. Think about that for a second. If you find a $100 bill on the street, you feel pretty good. But if you lose a $100 bill from your wallet, it ruins your entire day. We are biologically wired as humans to treat financial losses like physical threats to our survival. When the market tanks, your hunter-gatherer brain treats that red arrow on your screen the exact same way it treats a predator in the wild. It tells you to run away. It tells you to sell. But selling in a panic is exactly how you turn a temporary dip into a permanent loss. You lock in the damage. Legendary investor Peter Lynch ran the Fidelity Magellan Fund for over a decade, pulling in average annual returns of nearly 30%. It was one of the most successful funds in history, yet he noticed something tragic. The majority of the people invested in his fund actually lost money. How is that even possible? Because they would buy in when the fund was doing great, and the moment the market got scary, their emotions took over and they sold. They completely let their biology override their logic. This brings us to a massive trap that is designed to make you fail, which is the modern financial media cycle. This is something almost no traditional finance advice talks about. When the market starts to wobble, the news networks go into overdrive. You will see big red breaking news banners, analysts yelling about the end of the economy, and infinite doom scrolling on social media. You have to understand their business model. Financial news networks do not make money by making you rich. They make money by keeping you glued to the screen, and nothing keeps human beings watching quite like fear. When the market is calm and slowly growing, ratings are flat. When the market is crashing, ratings go through the roof. If you consume this noise during a downturn, you are voluntarily subjecting yourself to psychological warfare. The smartest investors I know completely turn off the financial news during a bear market. They understand that the daily noise is irrelevant to their long-term strategy. They know that reacting to a screaming television pundit is a guaranteed way to sabotage their compounding. If you want to stay grounded when the market is crashing, the first step is to ruthlessly cut out the fear-mongering media that is trying to manipulate your emotions for ad revenue. Before we get into the exact math of how compounding works during these scary times, if you are serious about building real wealth and breaking free from the traps that keep most people poor, hit that subscribe button to Finance with Max. We are building a community of people who look at money differently, and having you on board is exactly what this channel is about. Now let us talk about the reality of market history, because we need to normalize what a crash actually is. People act like a market downturn is a rare, once-in-a-century anomaly. It is absolutely not. Declines are a completely normal, healthy, and expected feature of the stock market. You are going to live through dozens of them. Historically speaking, a market correction, which is a drop of at least 10%, happens roughly every single year. A bear market, which is a drop of 20% or more, comes around every 4 to 5 years. And a major collapse, something like 30% or more, tends to happen about once a decade. Think about the dot-com bubble, the 2008 financial crisis, or the massive drop in early 2020. These events are woven into the fabric of investing. If you are going to put your money into the market, you have to accept that volatility is the price of admission. You do not get the historical average of 8 to 10% annual returns without sitting through periods where your portfolio looks like a disaster. Once you accept that crashes are guaranteed to happen, you stop trying to predict them and you start preparing for them. Here is the mathematical secret about compounding that you absolutely must understand. Compounding is incredibly powerful, but it is also highly asymmetrical and very fragile. Let me walk you through the numbers because this will change how you see your money. Imagine you invest $10,000. In the first year, the market goes up 10%, so you have $11,000. The next year, it goes up another 10%, putting you at $12,100. Everything feels great. But in year 3, the market drops 40%. You are no longer at $12,000. You are suddenly down to $7,260. You just lost all your gains and a big chunk of your original money. But here is the critical part that most people miss. To get back from $7,200 to $12,100, you do not need a 40% gain. Because your money pool is smaller, you actually need a massive 67% gain just to get back to where you started. Losses require exponentially larger gains to recover from. This asymmetry is why you can never afford to interrupt your compounding by selling at the bottom. And the data on this is absolutely brutal. Fidelity ran a study looking at an investment of $10,000 in the S&P 500 from 1980 all the way to the end of 2022. If you just left the money alone and did nothing, it grew to over $1,082,000. But if you tried to time the market, if you got scared and pulled your money out and you missed just the 5 single best trading days in that entire 42-year period, your returns dropped to $671,000. Missing just 5 days out of thousands cost you over $400,000. If you missed the best 50 days, you ended up with a pathetic $76,000. You took all the same risks, you sat through the same stressful years, but because you jumped out and missed the recovery, you destroyed your wealth. And here is the kicker. The absolute best trading days in market history almost always happen right in the middle of or immediately following the absolute worst crashes. 7 of the 10 best days in the market happened during the 2008 crisis. If you sell out of fear, you lock in the loss and you guarantee that you will miss the massive upward surge that follows. So how do we fix this? How do we build a system that saves you from yourself? The answer is automating your dollar cost averaging. This is the ultimate weapon against market crashes. Instead of trying to guess when the market has hit the bottom, which is impossible, you invest a fixed amount of money on a strict schedule. Maybe it is $500 on the first of every month, no matter what. When the market is booming and prices are high, your $500 buys fewer shares. But when the market crashes and everyone else is running away, those same exact shares are now on clearance. Your $500 automatically buys significantly more shares because the price has dropped. You are literally buying assets at a steep discount without having to think about it. If you keep doing this through a 2-year bear market, you accumulate a massive pile of shares at dirt cheap prices. When the market eventually recovers, and it always has, that massive pile of cheap shares explodes in value. You actually want the market to stay down while you are in your accumulation phase because it allows you to buy more of the companies that run the world for pennies on the dollar. Automating this process is key because it removes your flawed human emotions from the driver's seat. If this strategy is making sense to you and you want to keep mastering the psychology of money, make sure you are subscribed to Finance with Max. I drop deep dives like this regularly to make sure you are always ahead of the curve. Now, I want to introduce a concept that goes beyond just playing defense. Most financial advisors tell you to build an emergency fund of 3 to 6 months of living expenses. That is great advice, and you absolutely need that cash sitting in a high-yield savings account so that if you lose your job during a recession, you are not forced to sell your stocks to buy groceries. But I want you to go a step further. I want you to build an opportunity fund. This is a separate pile of cash that you deliberately hold in reserve for when the market collapses. When blood is in the streets, cash is king. During the 2020 crash, or the 2008 crisis, the people who made the most money were the ones who had liquid cash ready to deploy while everyone else was over-leveraged and broke. Having an opportunity fund completely changes your mental state. When you see the market drop 30%, you do not feel fear. You feel like a kid in a candy store. You have dry powder ready to fire. You can step in and buy premium assets, whether that is index funds, individual blue-chip stocks, or even real estate, at valuations that you might not see again for another decade. This shift from a defensive emergency mindset to an offensive opportunity mindset is what separates the middle class from the ultra-wealthy. The final piece of the puzzle is building an unshakable portfolio through real diversification. A lot of beginners think they are diversified because they own Apple, Microsoft, Google, and Tesla. That is not diversification. That is just concentrating all your risk into the tech sector. When tech takes a hit, like it did in the early 2000s where the Nasdaq lost almost 80% of its value, that kind of portfolio gets entirely wiped out. True diversification means spreading your capital across different asset classes that do not perfectly move together. You want broad market US index funds, but you also want exposure to international markets. You might want some stability through government bonds or treasury bills. You might want physical real estate or REITs. You build a ship with multiple watertight compartments so that if one section takes on water, the whole ship does not sink. This allows you to do something magical during a crash called rebalancing. If your stock allocation drops significantly but your bonds hold their value, your portfolio becomes unbalanced. You then sell some of the bonds that did well, and you use that money to buy the stocks that just crashed. It is a forced mechanism that makes you sell high and buy low without requiring you to make emotional judgment calls. Surviving and thriving in a market crash has absolutely nothing to do with being a genius stock picker. It has nothing to do with having inside information. It has everything to do with understanding market history, setting up unbreakable automated systems, and mastering your own psychology. You have to write down your plan today while the sun is shining, so that when the storm comes and everyone around you is losing their minds, you can just look at your written strategy and stay the course. The wealth transfers that happen during market crashes are historic. Money simply moves from the panicked hands of the unprepared directly into the patient hands of the disciplined. You now know exactly how this mechanism works. You know the math, you know the history, and you have the strategy. The next time the market plummets, you are going to be ready. Thanks for hanging out with me today. And if you want to make sure you never miss another strategy to build your net worth, hit subscribe to Finance with Max right now. Stay disciplined, keep compounding, and I will see you in the next one.